Welcome back to the deep dive. So, if you think about beverages in India for the last, 30 or 40 years, it was really a binary choice.
Hmm.
For decades, if you wanted a cola, you were choosing between red or blue. That was it.
And that long-standing duopoly, absolutely dominated by Coca-Cola and PepsiCo,
Yeah.
it didn't just define the market, it was the market.
But that entire era is, it's collapsing now.
Oh, it's not just collapsing. I mean, it's being violently restructured. The cola wars are back, and they have shifted from this two-way stare-down into a ferocious three-way battle.
Okay, so that's our mission today.
That's our mission. We are diving into this stack of reports, historical docs, consumer studies, to really understand the resurgence of, the ultimate homegrown brand, Campa Cola.
And this is so much more than just nostalgia, isn't it? We're analyzing how Campa's new strategy, backed by a corporate powerhouse, is forcing these global giants to rethink everything.
Everything. Their pricing, their distribution, their margins. And they're doing it in what is arguably the world's most dynamic major economy. So to do that, you've pulled together quite a range of sources.
A fantastic range. We start with the brand's original history. Yeah, its first rise in the 70s, and its pretty dramatic fall.
Then we have a fascinating consumer study from 2006.
Yes, which gives us this psychological baseline for what really drives people to buy a soft drink. And then finally, we get to the latest business reports detailing the massive investment and the, frankly, stunning market share shifts happening right now.
Okay, let's unpack this. We have to start where the whole story begins, which is with regulation. Take us back to the 1970s.
Right, we're talking about 1977 and the infamous Foreign Exchange Regulation Act, or FARA.
FARA, right.
And this was legislation designed to promote Indian ownership, Indian self-reliance. It basically dictated that foreign companies had to dilute their equity down to 40%.
And most companies, they sort of gritted their teeth and did it. But Coke drew a line in the sand.
They did. Because FARA also required them to share proprietary technology, their trade secrets. And while Coke was willing to dilute its ownership stake to 40%, they refused, point blank, to disclose the secret recipe.
That formula.
For them, the formula was the brand. It was non-negotiable.
It's incredible to think they'd walk away from a market like India rather than give up a recipe.
It says everything about how they value that IP, and that standoff led directly to them leaving in 1977. But, their exit left this giant physical void.
You mean the bottling plants?
Over 20 active bottling plants, a huge retail distribution network, all just suddenly sitting there, inactive.
So who steps in?
Well, who better than the people who knew the business inside and out? The Pure Drinks Group, the very same entity that used to manufacture and distribute for Coke.
Of course. They saw the opening immediately.
Instantly. They launched Campa Cola in '77, and they capitalized completely on that nationalistic moment. The tagline was genius, the great Indian taste.
They weren't just selling a drink. They were selling a homegrown replacement for the American giant.
A potent message.
Yeah.
And they marketed it with serious muscle. You mentioned the cultural memory.
Oh, the TV ad. It's a classic piece of trivia, right?
A huge piece. The Maiden 1983 commercial, shot in the Andaman Islands, gave a 16-year-old Salman Khan his first ever ad break.
Alongside Aisha Dutt, who later became Aisha Shroff, and that jingle, "There is more to life with Campa Cola," everyone knew it.
It was an anthem. They were woven into the fabric of the 80s.
So they had the culture, they had the infrastructure from Coke, but their success was totally dependent on India staying a closed, protected market.
And that shield just evaporated. The decline came with India's economic liberalization in 1991. The doors were flung wide open.
Pepsi had already snuck in a bit earlier, but Coke's official re-entry in 1993, that was the game changer.
That was the death knell.
Yep.
Campa just couldn't compete with the astronomical marketing budgets, the global supply chain expertise, the sheer scale of the returning giants.
They didn't have the deep pockets for a price war or a marketing war.
Exactly. So their plants shut down by the early 2000s, and the brand just faded, became a nostalgic footnote.
Okay, that context is absolutely crucial. Now let's pivot to the customer. This 2006 study helps us understand the why behind the buy.
Right. This study, conducted in Shimla, it gives us a really solid baseline. And it confirms the obvious, cola flavor was king, followed by lemon and orange.
And even back then, Coke and Pepsi together held, 64% of the market?
A combined 64%.
Ah.
But the really deep dive here is the psychology. Why are people buying these drinks when they aren't thirsty?
The emotional drivers.
Exactly. The psychological insights are what's truly fascinating. When asked about non-thirst benefits, the top reason, cited by 34% of people, was feeling pampered.
Pampered, so like a reward, a little treat.
A treat. And feeling confident was a very close second at 31%.
Wow, so over 3 out of 5 purchases were driven by this need for an emotional boost. It's an accessory to feel better about yourself.
Precisely. And what's interesting is what it wasn't. Only 13% said it was about social needs, feeling acceptable. It was a personal indulgence.
Which plays right into the branding wars. The giants sold feelings, not just flavor.
Absolutely. Cola for teens, thumbs up for the 20 to 30 crowd, Fanta for preteens. And Coke, interestingly, went after health and figure-conscious people, especially teen girls.
So how did people choose? What was the biggest influence?
It wasn't the shopkeeper. The two leading factors were advertisements at 34% and just inner instinct at 31%.
So marketing and impulse?
All marketing and impulse. And critically, only 7% said availability was a factor. Why? Because by 2006, these drinks were already everywhere.
That is the perfect pivot to today, because if the old game was about advertising and emotion, Reliance is about to flip all of that on its head.
This is where the story gets really strategic. Reliance acquires the Campa brand in August 2022, and the price was surprisingly low, just 22 crores.
For a brand with that much recall, that's a bargain.
It's a steal. They relaunched aggressively in March 2024 with the core flavors, plus new energy drink variants.
And we hear this term, the geo strategy, referencing what they did in telecom. Is it really comparable?
I'd say it's even more aggressive because you're dealing with physical logistics. The strategy is pure disruption, focused on two things: consumer price and retailer margins.
Let's talk numbers, because the price points are just shocking.
They undercut the duopoly by roughly 50%. A 200 milliliter bottle of Campa is 10 rupees, while competitors are selling 250 milliliters for 20.
And a 500 milliliter Campa is 20 rupees versus a 600 milliliter competitor bottle for 40.
They are going straight for the price-sensitive customer.
Which, if we connect it back to that study, means they're deliberately ignoring the 65% who buy for emotional reasons, the pampered or confident feeling.
They are. They're targeting the segment that prioritizes price, which analysts estimate is about 25% of the whole market. Their strategy is, we don't need to win the emotional battle if we own the price floor.
But the truly genius part isn't just the sticker price, it's the retailer incentive.
This is key. Reliance is offering significantly higher trade margins. We're talking 6 to 8% to the local Kirana stores.
Compared to the standard 3.5 to 5% from the big guys.
Right. You're basically paying the shopkeeper double to give you prime placement and push your product first.
Which neutralizes that old finding from the study that availability wasn't a factor. Now, availability is a weapon.
And it's a weapon backed by Reliance's unmatched physical infrastructure.
So let's talk about that infrastructure.
Well, they're leveraging their whole ecosystem. You have over 19,000 of their own stores. Reliance Fresh, GeoMart, where Campa gets mandatory placement.
And then there's the partner network,
which is huge. 30 lakh merchant partners, and they're aiming for one core. They can push Campa through channels Coke and Pepsi just don't have integrated access to.
And they're building the capacity to make sure there are no supply shortages.
Oh, this is aggressive scaling. A new plant in Guwahati, Assam for the Northeast. And the big one, a planned 1,000 crore rupee bottling and manufacturing facility in Bihar.
1,000 crores. So why Bihar and Assam? What does that signal?
It signals a direct challenge to the duopoly's distribution map. These are massive logistical hubs, placing capacity right where consumption growth is expected to explode in eastern and northeastern India.
They're cutting down the supply chain.
Drastically.
Yeah.
And beyond the physical assets, they're poaching talent.
Right. They got the former chairman of Coca-Cola India,
T. Krishnakumar, and Prasoon Joshi, the ad man behind Thums Coca-Cola. They're using the veterans' own playbook against them.
So what's the immediate fallout? What does the 2025 market data tell us?
The impact is immediate. The total market is valued at 60,000 crore rupees. Campa is already claiming 14% market share in its key markets.
And it's not just Campa, is it? Other local brands are rising too.
Exactly. When you combine Campa with players like Lahori Zira, these emerging brands have more than doubled their share in that crucial 10 rupee price segment. They've gone from 7% a year ago to nearly 15% now.
So the duopoly's combined share has slipped from what, 93%?
Down to around 85%. And Campa itself is projected to cross 1,000 crore turnover in its first full year.
An assault like that demands a response. How are Coke and Pepsi fighting back?
They've been forced onto the defensive. They're quickly rolling out their own 10 rupee packs for Coke, Thumbs up, Sprite, Pepsi, everything.
They have to compete at that price floor.
They have no choice. And we're seeing these promotional offers too. Coke is selling a 350 milliliter bottle for 20 rupees, basically giving you 150 milliliters for free.
That kind of price war has to be painful on the margins.
Incredibly painful. It's already affecting non-cola sales for Pepsi's Tropicana and ITC's Be Natural. Everyone's getting dragged down.
So if everyone has deep pockets, Reliance, Coke, Pepsi, what's the long-term implication?
Well, analysts believe it's going to lead to market consolidation. Smaller players just won't survive this. But more broadly, Reliance is exploiting a core vulnerability in the Indian market itself.
Which is?
It's incredibly low per capita soft drink consumption.
How low are we talking?
It's shockingly low. Only about 12 liters per person per year in India. You compare that to China, which is at 79 liters.
A huge gap.
A massive gap. Reliance isn't just trying to steal market share. They are investing to fundamentally expand the entire market by making the product universally affordable. They're targeting underpenetration.
So the goal isn't profit right now, it's volume saturation. The big investments in places like Bihar are about future dominance, not immediate returns.
That's the key takeaway. Reliance isn't selling a soft drink. They're selling affordability at scale. And their integrated ecosystem gives them an advantage the traditional models can't match. This is a long-term play.
The Campa Cola story, then, is this compelling case study of how nostalgia, plus a massive distribution network and unlimited capital, can just completely disrupt a stable duopoly.
Exactly. They saw that while Coke and Pepsi spent 30 years perfecting emotional marketing, they left the price-sensitive bottom 25% of the market wide open. And by owning that segment, they forced the incumbents to compromise their own premium positioning. It's a permanent structural shift.
And we heard they're already looking to expand internationally, even as this war is raging at home.
They are. They're launching Campa in the UAE at Gulf Food 2025, with plans for other markets in the Middle East, Asia, and Africa. They're taking this low-cost model global.
Which leaves us with this final provocative thought for you to chew on. If Reliance successfully replicates this infrastructure advantage, this aggressive low-margin model in other emerging markets, what does that mean for the future of soft drinks worldwide? Does the old duopoly suddenly face a new global competitor that plays by a completely different set of rules?
Something every multinational beverage company should be watching very, very closely indeed.